I'm going to walk you through it. This move that we have just seen Bitcoin do is a textbook, almost one-to-one perfect textbook example of a Wyckoff distribution event. And so this is so important to understand because this sounds highly technical. There's lots of, acronyms and little letters and stuff on here. But what you need to understand is that this is not a fluke. This is not just an interesting pattern that arises in markets from time to time. This is an executed and planned campaign that is run by the controlling interests that dominate the supply. So throughout all of 2020, when we were in that huge accumulation, we had large parties that were controlling the supply, and all of this bull run has been a textbook execution of a Wyckoff distribution. So let me explain this to you, because the thing again to keep in mind is that this is done intentionally to deceive the public and to take the most money from uninformed investors and retail traders. That is exactly why this schematic was developed. This was developed by a man named Richard Wyckoff, who in the 1920s and 30s was so pissed off at the rich interests controlling the market and, as he says, fleecing the public, that he wanted to educate the common investor on how these markets are actually run. And I think with the welcoming of the institutions into the crypto space, they're here. And now it's time for us to wisen up and understand what Richard Wyckoff was trying to educate the public back in the 1920s about how these interests move the market and what they're actually doing. So let's go through this 2020 bull run. I mean, you can see here these two graphs, everything from, this first move, the PSY to the BC up to the UTAD, and how it correlates exactly with this schematic of Wyckoff's distribution. So let's talk about each of these moves and why they happened, what they do psychologically, and how this whole thing plays out so that the controlling interests benefit the most on the way up and then on the way down. So let's walk through this. It's again important to note that Wyckoff put this together to educate us and to help us understand his concept of what he called the composite man. The composite man you can think of as, it's not just one person that's pulling the levers behind the scenes. That's why it's this composite man. All of these big interests, the big whales, collaborate together and are actively working together to execute this as if it was the intention of one person. So all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it, which is why this is so important. This is not all doom and gloom, but we need to understand the institutions, the big players have arrived, and they just pulled a doozy on the general public. So I really invite you to read this article. I will put the link in the description, but what I'm going to do now is I'm going to walk through these phases step by step so that you can understand what just happened in the 2020 bull market and why. So here we go at the distribution event as Wyckoff documented it. So before this diagram, there is an accumulation that lasts for a long time. I mean, years of accumulation where these large interests are dominating the supply, getting ready and building a cause for a up move like this. And when this happens, when we have this big rocketing rise in price, you can see, Bitcoin shot up from really around $10,000, $11,000 in September, October, up to $60,000. This is a huge uprun. So the way that this works is at a certain point in that in that parabolic move, they trigger this sequence. The first indication that this is going to start is with this PSY. This is the preliminary supply. This is the first time that those large holders dump supply into the market. They take this huge uptrend and they actually force a correction that kind of triggers and sets into motion these next events. The BC is the buying climax. I'm sure a lot of you remember this. I know I do. I bought in right along here, and I bought in again right around here when all of the news was coming in. This was around right around almost $60,000. This was just in the peak of that fever, and I remember thinking, oh my gosh, the price is never going to be lower again. Tesla's in, the institutions are here, we're in a bull market. This was just this fever run up to this buying climax. But this is all orchestrated, so what they do at the buying climax right around this time is they drop the price and start this trading range. So they dump supply into the market. We have a huge, all of a sudden, correction. This was that big first dump that we saw down to the AR, which stands for automatic reaction, because we have this huge, surge, and then they dump supply. And as soon as they're done dumping, they're still buying. So we get this, first kind of move, that bounce out of this first correction. This is the ST, the secondary test, in which price revisits the area of the BC to test the demand and supply balance at these price levels and for a top to be confirmed. So they're trying to confirm that buying climax was the top. Now we've got this trading range defined between the buying climax and the automatic reaction. So then, as they continue to manipulate the supply, they actually cause fear by bringing the stock from this, secondary high all the way down to the show of weakness or sign of weakness. And so I'm sure a lot of you remember this. This is when it went down to $43,000. Great buying opportunity for those of us that were following. But that was that show of weakness, sign of weakness, that $43,000 price that we hit right here. In early March, late February, and what that does is it occurs at or slightly below the trading range, and it's used to indicate a change of character in the price action of the stock. So this is the moment where supply becomes dominant. They've actually increased the supply all the way down, actually breaking the trading range, creating this lowest low of the trading range, and then we have this next move up to the UT. So there's a couple UTs that happen. These are up thrusts where, we hit a low, but there's this huge demand, this huge interest in this narrative of us going to 220, etc. So we get up to these up thrusts and then back down again. And so this whole range, what has been happening as it goes up and down and consolidates and, hitting this resistance, $60,000 has been the ceiling that we just keep bumping up against. This whole thing is engineered in Wyckoff's view to exhaust demand. And if you think about how you felt in the last 3 months from this surge of that buying climax to just this, going through the ringer, it has exhausted demand where people are no longer willing to buy at that $60,000 mark because we keep having these corrections, we can't get out of the zone. So that's what this whole phase in phase B is about, exhausting demand. So then what we all just experienced a week ago, that fateful Friday and then Saturday, where all of a sudden the price ran up, past 60,000. We broke out of the range. Everyone was excited. This is called the UTAD. This is the up thrust after distribution. So they've already done their distribution and they've set up their short positions that they're ready to take on the way down. And then they do this final test. This is let me read it here. It occurs at the later stages of the trading range and provides a definitive test of new demand after the breakout above the TR resistance. And this is analogous to what's called a spring in the accumulation phase, where they dip the price really low to kind of trap all the bears in accumulation, and then they shoot the price up really high to trap all the bulls before phase D. So they've, benefited the most from their control of the stock. They've exhausted the demand. They've set up their shorts, and now the whole sequence is taking this back down. So these LPSYs, this is where we are now. This is, today's prices as we've fallen down from the 60, and everyone's saying, oh, this is just another dip like these other ones. It's just another dip. We're still going up. If you look at how this is engineered and what they're doing, just be advised that it might be a little bit longer until we're going up again. It's much more likely that we're going down into a larger consolidation that takes months for them to build their next position to make another move up. The market doesn't just move, the market is moved so that the people that are selling people something at a huge markup can then benefit from the shorts when it's marked down, and they build up that accumulation, and then they can do it again. But this needs to cool off, and that's what this whole next phase is. The LPSYs, after testing the support, and a feeble rally on narrow spread shows that the market is having considerable difficulty advancing. This inability to rally may be due to weak demand, substantial supply, or both. The LPSY represents exhaustion of demand and the last waves of large operators' distribution before markdown begins in earnest. So we're here in phase D, and the big question is, what does phase E look like? It's very hard for me to look at this sequence and understand how much benefit those controlling interests were able to get from taking their stocks that they owned the majority of, skyrocketing the price, then exhausting that demand so that they could bring it back down and buy everything back at a discount, only to accumulate and do it again. So how far are we going down? Do we really think that after a perfect textbook Wyckoff distribution with no reaccumulation, we're just going to rocket back to the moon? I really challenge everyone in crypto to, again, take that red pill, pause for a moment, and understand that the institutions that we wanted to arrive in this space have arrived, and they just left their calling card, a textbook sign of market manipulation to fleece the public